All right, welcome back, everybody. It is January 2026, and we're here to talk about performance, what happened in 2025, and a little bit of market expectations in 2026 with the Bridgeport Asset Management team. John, Ian, thank you so much for joining us. We had a fantastic year last year, and when we talked this time last year, the kind of outlook on what was going to happen was good but not great, and it turned out to be a pretty good year. How did you guys feel coming out of 2025? And like Ian, like maybe what were your thoughts that came like to fruition, and then what maybe are something to keep an eye on?
Yeah, great. Thanks, Tyson. I think we should probably just recap 2025. It's on the public equity side, it was the third year of very strong returns in most equity markets, especially North America. S&P 500 did close to 18% total return. The TSX did over 31% and change total return, and the Dow did 13. So I think if we went into the year, most people would not have been predicting that, especially on the TSX. And it's the third strong year of returns. Often, I know people are quite bullish going forward, but I think there's a reason to be cautious as well because usually you don't have good returns after good returns. But if we do walk through 2025, if we look at Canada, it was really driven by two sectors: materials, which includes the gold stocks, and financials. Those two sectors make up, materials and financials, 50% of the market. And not only were gold stocks good, but a lot of the banks returned 40 to 50+% in market cap, which is quite amazing when you think about it, which is
Yep.
generally good for people's portfolios because we own the banks and a lot of Canadians own Canadian bank stocks. Strength in the U.S. market was another year driven by technology and technology-related stocks. The top seven stocks represent about 34% of the S&P 500 and represented more than 50% of the performance. There was a lot of stocks in the U.S. market that did not do well, so the breadth of the market, again, was not there. It was a very tight group of companies that gave the performance, the S&P, up, like I mentioned, about 18% in U.S. dollar terms. As we walk through 2025, the beginning of the year started off very strong. We had just got off interest rate decreases at the end of 2024, and earnings were coming through. And then we hit April, Liberation Day, which was really about a 10-day drawdown in the market or decrease in the market that we hadn't seen since COVID in 2020. But it was a very short time frame. People were worried about recessionary fears from trade, the U.S. tariffs, etc. But the market bounced back quite quickly. I think after Liberation Day, the equity market and investors generally became immune to some of the policies that came out of the U.S. and policies that were around the world. Is there seemed to be something new every day. It was just way too much to digest, and the market just moved forward because of it. And earnings growth came through in companies, which is the most important thing. Is we have growth in cash flows and growth in earnings in companies, and that was to sustain relatively high multiples. The only sector in the U.S. that I would say was, and we had obviously the AI factor, the AI theme, was a positive generally in the market, with the exception of software stocks, which have struggled significantly with the concern that artificial intelligence will be a negative for a lot of enterprise software stocks. So that was. And then clearly we finished strongly, as we mentioned, with strong performance. As we move into 2026, we're not big on predicting overall markets, but a couple things I think are worth noting. I mean, obviously, we all know global geopolitical events are driving the headlines and will continue to drive the headlines. And there's way too many of them to mention here. I think the new Fed chair in May plays a factor. Obviously, I think the U.S. government, Trump's going to put in someone that's friendly to decrease in interest rates, which initially will be helpful for the markets. Earnings should come through in a lot of industries. I think they'll be relatively strong, at least for the 2 or 3 quarters. However, stocks are expensive if you look historically on a PE basis, especially in the U.S. And we haven't seen a lot of volatility. At the beginning of last year, I think one of the things I mentioned was we'd have a volatile year, and actually we didn't really have a volatile year. We had a very volatile April, and then after that it was pretty well straight up. So that volatility should come back into the market. I mean, if you look historically, especially what's going on in the world right now, I mean, it's, as we know, a different thing each day, a different event each day. So people should brace for more volatility than they saw in 2025. And I think the consensus is the market breadth will widen out, i.e., it won't just be such a small group of stocks that drive performance, and that would be helpful for us, but it would be helpful for portfolio managers and investment firms that run a good diversified portfolio. Even though we run a concentrated portfolios of 20 to 25 stocks, we diversify it by type of business in there. And I think consensus is, as we go into 2026, that some of the companies that were sort of left behind and didn't get appreciation, even though they were doing well, should have better stock performance as we go into 2026. And lastly, just in our portfolio, some of the individual stocks that did well, if you look at the U.S. fund, it would be Applied Materials, semiconductor capital equipment company. We've owned Alphabet for a number of years, as people know as Google. That's done quite well. In the Canadian fund, Cameco was a stock we bought during the year when it had a downdraft, and it was very, very good, strong performance. So those are a handful of stocks that did quite well for us this year. I think I'll leave it at that and maybe pass it over to John.
Yeah, sure. I mean, happy to talk if I guess you'd like about our fixed income fund, the Bridgeport High Income Fund, and of course we have our 3 private asset funds, that focus on private equity, private credit, and real estate, as well as infrastructure. I guess maybe just talking a little bit about the High Income Fund. It had a pretty good year. Was up around 7%, which obviously pales in comparison to the broader stock market. But of course, this is largely a fixed income, i.e. a bond fund, a corporate bond fund. So we're lending money in the fund to various corporations, primarily in the US as well as Canada. And most of the return is typically earned in the form of interest or else dividend payments. It's a pretty widely diversified fund. So it includes everything from corporate bonds, convertible bonds, preferred shares, floating rate, i.e. kind of variable rate, interest rate, senior loans. And only about 20% of the fund is dividend paying common stock. So it's mostly fixed income. 80% is in those kind of categories that I mentioned, and about 20% is in dividend paying stocks. And so most of the return this year, we got a little bit of appreciation. And most of the return, though, did come in the form of receiving interest as well as dividends. So obviously, it's a little bit more of a boring, steady Eddie strategy compared to the sexiness of equities, but it's proven over. We've been managing it for 18 years. It's proven to be a really good stabilizer in a portfolio, particularly in years where equities maybe haven't done as well as say they did in 2025.
Yep.
And it's highly diversified. There's 40 plus different investments in there, so we're really earning a base of income from a wide kind of variety of investments, as well as companies. In the private asset world, it was an interesting year in private assets. It's probably one of the weaker years that private assets have had across the board. It was a little bit of a inflection point year, I would say. Probably the easiest one to talk about would be real estate. Real estate's really had a 25-year bull run, probably from the mid 1990s till just around 2022 when interest rates rose. We also hit the pandemic. It changed tenant uses of real estate, work from home. So that obviously hit office. And so there was a lot of changes that took place in the commercial real estate world in 2022, 2023, and we saw some of the lingering effects of the higher interest rates in 24 as well as 25. So It kind of seems like real estate in general was turning the corner from a valuation perspective. A lot of the write-downs that people were taking kind of occurred in 24 and the first part of 25, revaluing real estate in a slightly higher interest rate world, taking into account some of the issues, as I said, that came about as a result of shifting sort of tenant kind of demand as a result of COVID, as a result of e-commerce in the retail world. But we're starting to see that kind of pick up now. And I think a lot of people believe, as do we, that there's actually great opportunities in the real estate world now. We've been making allocations out of that fund to some phenomenal managers that think they're picking up assets now at extremely inexpensive prices, and that should set us up well going forward in terms of future investment returns. The infrastructure part of that fund, because it's a really combined fund, has also held up the fund well. It's performed better, I'd say, the last couple of years than the real estate sector has, and I think they're seeing a number of good opportunities there. And we have some very large, big name fund managers that we've allocated capital to, some of the flagship Brookfield funds, as well as some large US managers in a wide variety of different real estate and infrastructure segments. Turning to private equity, I'd say that's where we've really seen a bit of a pause. I think, again, higher interest rates have sort of in 24, 25 resulted in valuation adjustments. And so it's led to more modest rates of return, particularly compared to public market returns. I think some of the stuff going on in the States with rapid policy changes, all the tariff noise, I think some of the managers have adjusted kind of valuations. But again, toward the end of the year, we started to see things really pick up, kind of like there was a little bit of light at the end of the tunnel. And so even though we did generate positive returns there, what we sort of saw was a lot of them came in the last part of the year. And it seems to be, or at least it's looking like a pretty good setup for improved returns in 26. Very similar story, I'd say, with the private credit fund. Less volatility there, but there was, broadly in the market, there was some excess. There was a few people taking write-offs here and there. I think some of the news we've seen in the paper with other private debt funds really kind of vindicates the approach that we have taken. And what I'd say is, it's an area that you need to be really careful in, especially if I think private assets in general is an area that you need to be careful in. I think because you don't want to allocate to a single manager with a single strategy. And I think you need to be really careful about doing that here in Canada. We're really small. And the opportunity set is a lot smaller than it is in the US and a lot smaller than it is just globally. And I think when you're talking about private lending specifically, it's a really small market. The banks and the larger financial institutions here tend to cherry pick the best loans, and picking through what's left, if you're an independent private debt fund that is investing, retail and in some cases institutional money, you need to be really careful what deals and what loans you are making, because it's probably coming to you in the first place because it's something a bank won't do. Whereas in other jurisdictions like the US, it's just a broader market, and the banks have sometimes exited and are actually underwriting less loans, and they are actually leaving the marketplace more to independent funds. And so what we've seen in Canada is a lot of problems. People have raised pretty large private debt funds, and I think their issue is they cannot get the money fully invested without taking undue risk. And that starts to show up. For a while, they're generating really great returns and everyone's happy. But then you later find out, well, they put 30% of the portfolio into 2 or 3 loans. They have $1 billion fund, and 300 million of the fund is in 3 loans, and those loans now are in receivership. The underlying company is bankrupt, and the loans aren't worth 300 million. And so, one of the things that we've been really cautious about is that we are invested in a number of funds globally with different types of asset kind of collateral, different types of lending, leasing, and royalty strategies. So we're really well kind of diversified. And so we've seen a few little issues here and there, but it's been really minor. But I think it's just an area to be careful. I think what we've seen again, latter part of the year, we're coming out of that, and we're expecting better returns, I'd say across the board from all of our strategy into 2026.
Awesome. That's a great rundown.
Tyson, if there's one thing I could add as well that I didn't mention is we see a broadening out of equity performance, i.e. Beyond the top 7 or 10 stocks in the U.S. It should benefit the small mid-cap space as well. Small mid-cap, with the exception of materials, really didn't have a great year if you take out gold stocks. And I think as we see a broadening out, because valuations in the small mid-cap are generally low, depending on, as long as it's a quality company. And as an example, we had 3 takeovers in the small mid-cap fund this year, Parkland, Guardian Capital, and Dental Corp, which I think are a reflection of the fact that investors have ignored the small cap and mid-cap space for a while. So there should be good opportunity there too if we see a broadening out, because we have a portfolio of 25 companies that I firmly believe are undervalued and good businesses. And as we see that broadening out, it should help them as well. So just something to add that I didn't mention earlier.
Yeah, no, that's good. That was on my list of questions actually, is because that's sort of what we've been hearing is as we get out of these, predicted choppy waters and everyone's kind of willing to venture out of large cap only, is I'm hearing that small and mid cap may have a better performing year. And so, yeah, one of my questions is like, why do we think that? So that was a great response to that. The Fed announced that QT is ending, which means quantitative easing might be something on the table for the south side of our border. Do you think that's going to have an impact? Like John, you were just talking about the private equity markets and the infrastructure kind of coming back to life and having some outlook. Do you think the end of QT will have positive response on that, or does it not affect it? Or what are your thoughts on that?
I mean, I think what we're seeing is probably like longer term structurally higher interest rates, slightly higher than we've seen pre kind of pandemic. We're definitely seeing inflation rates stabilize, particularly here in Canada. I think that's stable, that more stable environment. Everything in PE is kind of adjusting. And people are making capital allocations within their portfolio companies with slightly higher rates in mind. And so, I think if anything, it's just the stability now. We've seen the adjustment. It took a year or two, and that we've seen, I think, valuations come down slightly, and growth is coming back in a lot of sectors of the economy are doing okay. So, I mean, as I said, I think the setup going forward is good, and it's particularly good in private equity. I think in certain strategies, I think because of the lack of transaction activity, there is a lot of institutional investors that need to redeploy proceeds out of their private equity portfolio, and so not getting distributions back because the companies aren't getting sold as fast, and that creates opportunities for so-called secondary fund investors where there are managers that we have allocated capital to where their entire strategy is buying out existing private equity fund interests that hold a portfolio of private equity companies, and they buy them out at a discount. And the impetus for the seller is they need to get cash out of their portfolios, and they're not getting it from any other places. And so there's a lot of those players that need cash. And in any market where you seem to have maybe a slight imbalance between buyers and sellers, the buyer usually does quite well on pricing. And if you do well going into an investment on pricing, it usually bodes well for sort of future returns. So we see a number of strategies like that within private equity that have gotten increasingly interesting over the last couple of years.
Fantastic.
Yeah.
2025 was in terms of headlines and attention, it seemed that everything was driving towards like AI. Going into 2026 and maybe a little bit beyond, what are you guys hearing and what do you guys think about the landscape of the AI companies or the AI infrastructure? Are we going to see like more mergers and maybe acquisitions? Are we going to see roll-ups go through and pick up all of the smaller AI players? Like, how do you guys kind of see this landscape developing over the next little bit?
Ian, do you want to take
Yeah,
that? Yeah.
yeah, sure. On the public equity side, I mean, I think that there's a school of thought that there's overinvestment in infrastructure um, in terms of the hyperscalers, and I think that's probably true. There probably is an overinvestment. It's really to what degree is that overinvestment, and I believe Mark Zuckerberg, on the last Meta call said like we probably could be overinvesting, but the risk of not doing it is way too high. And I think that's sort of the thought process that a lot of companies have is we are potentially overinvesting, but we can't be left behind. For those large companies that are building a lot of infrastructure, I mean, the returns of their business are changing, right? Because they've gone from capital light business to capital heavier business, and that's something we keep in mind. I think so, but they're still good businesses, and it's only a portion of what they do. It's different than the year 2000 technology crash to me, and I lived through that. Is that there was a lot of smaller companies that had no business model that went public, and I'm sure there is now to a certain degree, but in those days it was extreme. And I don't really feel the same about it this time. I mean, there are some companies that probably have market value, big valuations that don't have a lot of revenue, but not the same as before. I think the interesting thing with AI is what effect it's going to have on software companies, which I mentioned earlier. And the school of thought is there's a lot of software companies that businesses are significantly impaired because of it. And I'm not so sure that's true, and that's something we're trying to work through. And it's not easy to work through that to figure out if the valuations on some of the software companies, which in some cases are down 50% in terms of valuation, is their business is really affected by that much. So that's something to keep in mind. I don't know if you'll see roll-ups. I think it's too early to see sort of like roll-up is usually when the industry is more mature. And I think when it comes to AI and related to AI, I think we're in the first, second inning, really, right? To see how this all plays out. That would be
Yeah.
my view.
Okay. Interesting. I like that. We hear different things from different points of view, and so it's nice to kind of get a more calm view. People are either all in or they're calling AI bubble and they're ready to get out. And it's probably somewhere in between, right? And we might be able to ride it out for a long time.
Mm.
Yeah.
So we've mentioned a couple of times about like headlines and headlines driving investor behavior and expectations. Um, so maybe if you guys can talk a little bit, like the way Bridgeport portfolios are designed is it's not going to be the top performing and beat everybody else. And it's also not going to be the lowest performing. It's going to be a smooth like transition to you hit your long-term goals, which is one of the reasons why we partnered with you guys. But can you talk a little bit about maybe like holistically or overall how the portfolio design is affected by headline noise and how it's not affected?
Do you want to take that, Ian, or
You go ahead, John. I mean,
yeah, I
start
mean,
talking about the
I'll
philosophy of our funds.
sure, yeah, I'll start off, Ian, and then I'll pass it over to you, and you can put your 2 cents in as well. I mean, I think first of all, our portfolios are really thoughtfully constructed. I think what we've seen with indexes increasingly is they're getting very heavily weighted into some sectors. It's largely played out well for the indexes. And, that's how these things go. They play out well until they don't. And everybody says with hindsight, wow, the index was really badly constructed. We've seen that story. I mean, not so much recently, but for those of us that don't have a lot of hair on their head or have been around a while. I mean, we all can kind of remember the days of whether it was Nortel, BCE, I think at one point became, Ian, correct me if I'm wrong, or like Tyson, maybe 35% of the TSX composite was tied up in two companies, and they blew up and took the index down with it. And we're sort of seeing the same thing in the US with the technology sector, and even within that sector, a lot of the companies people think are in that sector are not even included in that 40% or kind of 30%. It's, it doesn't include Google. I don't think it includes Meta necessarily. They're under different subsectors. So we're much more thoughtful about allocation across sectors, across individual names, so that the portfolios are better at weathering a storm. We're looking at different thematic risks as well and how they may impact individual companies, and making sure we don't have too much or that we're overexposed to any one thematic risk. The pandemic is a great example. I mean, it would have been very hard to predict because it was a once in a 100-year event, but who would have thought of people working from home as a thematic risk that we need to look at within our portfolio? I don't even think the most sophisticated pension fund investors like CPP were necessarily looking at that, but there are lots of other obvious risks that do every once in a while hit home. And so when we're looking to include companies into the portfolio, one of the lenses we look through is various types of risks, whether it's industry risk or just a broad general economic thematic risk. And what we've seen generally is when we hit downturns, the equity portfolios perform better than the broad market. And when you couple that with the other asset segments we get exposure to, fixed income, as well as all of those private asset segments, what we've seen is generally client portfolios are down a lot less than overall markets. But Ian, like, I'm sure you have something there to add, maybe.
Yeah, no, that's good, John. I mean, there's a number of things there. When you talk, when we mention indexes, I mean, if you look at the S&P 500, if you actually add technology and technology-like names, like John mentioned, Meta, Google, Uber, which is considered industrial, the technology weighting of the S&P 500 is really closer to 45% or more. And I think us as managers are very focused on being prudent in terms of, we own 20 stocks in our US fund. We want a good selection of different types of businesses. And some of those are technology businesses, but we wouldn't have 45% of our fund in technology businesses. That would be wrong for our clients. It would be unneeded risk. So I worry less about the index and more about building a portfolio of companies that can compound capital over time. And in any particular year, if 7 stocks or 3 stocks or whatever represent 50% of the performance, so be it. Like, we like where we're invested. So that would be one thought. The second thought, I think to your question, it was on the Bridgeport philosophy of having public equity investments and private investments. I think sometimes can mean that we may not have the same performance as one or two of the indexes, but we give better downside protection in a bad year. And John could talk about that, a little bit more, how we have the public equity and the private go together, and there's more of a buffer each year. But if the TSX is up 30%, probably not going to be there, to be quite honest, in my opinion, like in terms of all our portfolios combined together. But we're trying to grow individuals' capital over the long term, not any one particular year, even though we want to compound it every year. And I don't know, John, if you have something to add to that.
Yeah, I mean, I think we really saw that in 2022, which was just like a horrible year in stocks and bonds because of rising interest rates. The S&P 500 lost 20%. Most bond markets are down 10 to 20% as a result of rising interest rates to deal with the effects of the post-pandemic inflation. And, a lot of our portfolios were sort of flat or just down a couple kind of percentage points because of portfolio construction on our publicly traded equity side of things, and then the three portfolios. And because our private asset portfolios were all up between sort of 4 to 9%. And so when you have some portfolios that are generating positive returns relative to sort of negative returns and bonds and equities, you really end up outperforming and preserving capital. And look, that's just how things work. You get some years, it's virtually guaranteed, where they're going to be bad years from investing, and you get some years that are going to be great. You're going to have, time has shown, history has shown, you have way more good years than bad years. But the bad years happen. They will happen. It's 100% guaranteed they'll happen. We all wish we knew when they were going to happen. Every client asks that, as you all know. Nobody knows exactly. You know, if you make enough forecasts, you get some right. It's like there's some famous investors out there, famous economists, famous like economists, where, you know, the kind of line is they've kind of predicted 7 out of the last 3 stock market downturns. Well, yeah, if you're in the business of constantly making predictions, you get some of them right. Nobody really knows exactly. It's very hard to take macro forecasts and accurately incorporate them into a stock market forecast. People try with varying success, but it's very hard to do that consistently. So we really believe in that kind of diversified approach, proper portfolio construction in each of our different portfolios, and also having exposure to different asset classes. Because one of the things that kills returns more than anything else is when clients get panicky in a bad year where they feel like they've lost too much money. At the bottom, it never looks like it's going to get better. Never in any downturn I've ever been in have I ever really felt like I could make a strong case that we were at the bottom, even though it turned out we were, because there was always reason to be even more pessimistic. And so the easiest way to live through that is not to lose too much money when things are bad, so that you don't feel like your portfolio is in free fall, and that all hope is lost. It's also easier to recover from a small loss than a deep loss. As we all know, if your portfolio, it's not the same math. I mean, not that your portfolio, stock markets are down 50% too often, but a 50% loss in a stock portfolio requires 100% gain to get back to where you were. If you start with $100 and you now have $50 in a stock portfolio, and you need to go from 50 back up to 100, 50 to 100 is 100% gain. Not that you can't get it. It's a tougher climb, and the math is against you, and it's going to take longer. You will get back there, but if that loss is smaller, you get back to par where you started much faster. It allows you to compound returns easier. And so in some sense, yes, it is about generating good absolute rates of return, but it's also about generating good absolute rates of return with the least amount of volatility, because when you have a tighter range over time of rate of return outcomes every year, you end up compounding your money in a more efficient way, and you end up with a higher ending value. Just because big swings each way, they kind of grind away at the math of kind of compounding. So,
yeah, no, that makes a lot of sense. That kind of dovetails into a conversation we had offline where we were talking about clients being influenced by finfluencers that basically tell you to buy the index, set it and forget it, and you're going to make all this money. And clients of recent years seem to have lost grasp of the risk of investing. There's always some sort and some form of risk, where as much as portfolios can go up, they can also go down, which is why, proper diversification seems to be the only free lunch in investing. You guys do it very, very well. And I think having that kind of like Rosetta Stone built in of like, rule number 1 is don't lose money, right? Like, and that's Warren Buffett's number 1 rule, right? How are you guys talking to clients? What are you seeing in conversations with people that come to you that say, well, I was told, buy the index and it's going to do this, and we're going to have this, future all painted for us. What are you kind of saying to clients to bring into the reality of the investing risks that are always there?
I mean, we're talking a lot about, I think a lot of people have forgotten about risk. Like they are keen to go as close or up to 100% equities because equities have performed quite well, as we've talked about on this call. And they are forgetting you can have a downdraft. It could be significant. You're going to be very hard to predict when it's going to occur. And it may not be short in kind of duration. Like the history of the stock market is, it's not always a reward in the short term for buying on a dip. It is a reward in the long term, but we have not seen a prolonged stock market dip in a very long time. I mean, the pandemic was a very, very significant world and economic event, one, again, a once in 100-year event. We saw a very severe stock market dip in, Q1 and specifically March of 2020, over 5 years ago now. And I believe the dip top to bottom, depending which market, was close to 35%. But it really lasted like the real severe dip only lasted a couple weeks, maybe two actually, and it started to gradually come back. And that really didn't test investors' patience much. Some people thought it wouldn't last, so that was a test. But in terms of like, oh, I'm getting some of my like money back after this super severe event, it's not like it lasted a whole year. We sort of gradually climbed out of it. But there has been periods in the stock market where, look, you've got to wait a year, 2 years, maybe even 3 years. And then you may see a massive gain, after that, getting it all back plus. But it's that kind of, sort of, I hate to use the word, but I do think it's true. It's sort of that kind of psychological pain that investors have to go through. That's the reward. I mean, that's the cost of getting the end kind of reward of higher rates of return by investing in the stock market. And I don't know if people have really had to pay that price of late. I don't know if, particularly if a lot of younger investors are really used to paying that price. And it's somewhat inevitable because if you could just get better rates of return on a consistent year over year basis by investing in the stock market versus something safe like GICs, nobody would ever buy a GIC again. Like it would make no sense for the GIC market to exist. Why buy a GIC at 2 or 3% when I can get 8, 10, 15, 20%, or at least something better than that consistently in the stock market? And the truth is, you will not consistently get better returns than a GIC in the stock market. It's a built-in feature. There's going to be years you wish you bought GICs. The problem is you don't know which years those are going to be. And if you're not prepared to have a year where at the end of the year, you're like, wow, I wish I owned a GIC, then you're maybe not really a stock market investor. And that maybe is just a painful lesson. Some people are going to have to learn it. It's why, again, diversification is important. You don't have all of your eggs in the stock market basket. We should all have significant allocations as long as you're not super old in the stock market, but you just need to be careful putting all of your eggs in that basket. And if you do, you need to be prepared for some ups and downs, right? And as long as you are, it's fine. But I think a lot of people think they are until they're in the eye of the storm.
Yes. Yeah, that's funny. When I go through my risk questionnaire in my presentation with clients, I use that example of COVID. Said, if you came to me as a client and gave me all your money in January, by the end of the year, you'd hate me. You'd think I was the stupidest advisor ever. But if you came to me in April, gave me all your money, you'd think I was a genius because you just wrote it all the way up.
Yeah.
And so it's a timing thing. Short-term memory of investors can, really skew their view on things.
Yeah.
I think as we get ready to kind of wrap up here, I just wanted to ask Ian, like at the beginning of last year, you shared, or maybe it was the mid-year check-in, you shared that you guys had scooped, I think it was Uber, and you did really well at the beginning of the year. It had a really good turnaround. And is there anything that you're excited for or looking forward to in the portfolios for this year and maybe the year after that you think are really going to perform well?
Oh, well, I mean, I think it's a good question, and we did that mid-year in July. I think we had just recently purchased Uber, and we had great performance. It pulled back a little bit because of some competitors, et cetera, and perceived competitors, and competitors do exist. I still think they're well positioned. Individual stock wise, if I look at the U.S., we haven't made a lot of changes recently in the U.S. fund. One of the names that I still am very bullish on is LVMH, Louis Vuitton, even though the last week hasn't been good with some of the tariff talks with Europe, or this week particularly. I still think owning that stock, especially from this level, will be a strong compounder over time. Global branded behemoth when it comes to luxury, and as one of John, my coworker, Mike, always says, I'd be long rich people all the time. So I think it's a company that will continue to do well. A massive company with great brands. So that would be one that I would pick out in that. It's actually obviously a French company with headquarters in Paris, but we own the ADR in the U.S. fund, which we own a few ADRs and get exposure in global companies that are head office outside of the U.S.
Okay. That's awesome. That's good to invest in. We hear more and more about this K-shaped recovery and K-shaped style of investing. And so I think being able to invest on the upper part of that in the luxury brands and people who can afford it, who are not affected by what's going on in the economy, I think it's good to have in the portfolio. It makes a lot of sense.
Yeah, absolutely. It's a great diversifier outside of technology and branded companies. High-end branded companies have been around for a long time, and it's a good diversity as well of brands. I mean, sometimes with luxury companies, if you have one brand or two brands, they can go to style. This has multiple brands with a long legacy too.
Yeah, absolutely. Gentlemen, before we sign off, any last words, anything you want to add for the kickoff of the year of 2026?
Yeah, I mean, on the public equity side, I feel good. I feel excellent about our portfolio. I feel good about the markets, but I do think, and I mentioned it last year too, and maybe it didn't come true as much. I just think we're in for a volatile year. There's a lot of issues in the world that are clearly unresolved, and we seem to get more all the time. And while we haven't seen it affect the equity markets, I think this year it will. But for us, it'll provide opportunity as well, because will allow us to invest in companies that we've been following a long time that we want to buy at the right price. So that would be what I would talk about 2026.
Yeah, I would say, again, sort of just a prediction. I think public equities really carried client portfolios along with fixed income to a lesser extent in 2025. And I think depending what happens on public equity side, I think we may see the private asset categories really carry the client portfolios more in 2026. We'll see. It'll be interesting to kind of check in.
Yeah, fantastic. All right, gentlemen, thank you so much for doing this. This has been our 2026 kickoff and 2025 recap with Bridgeport Asset Management. I'm Tyson with Portfolio Planning. Thank you very much.